Hi, in this short video, we are going to have a brief discussion on short sales. So what is a short sale? Normally, in the traditional cut of a trade or a transaction, the position is called the long position. You buy a financial asset, and the expectation is that the price of that asset will appreciate. So you buy low and sell high. So when you buy, you open a position. And how do you close that position? By selling the asset later on and receiving the cash. In short sale, the opposite happens. A short sale entails a short position, which is the opposite of the traditional long position. So we sell first and then buy later to close the position. This buying back is also called the covering the short. So why would somebody want to do that? Short selling happens when investors want to benefit from the decline in the price of a financial asset. Okay, so you sell first. But how do you sell something that you do not own? Well, for this you will have to borrow. Usually the borrowing is done from a dealer. So the dealer sells it and deposits the selling proceeds to your account, which also includes a margin. So later on, when you cover the short, you have to buy back those stocks and give it back to the dealer. And the differences between your equity will be your profit or your loss. Let's take a look at an example to understand this better. Let's say our XYZ company is currently trading at $100 per share. We want to enter into a short position for 1,000 shares. So if we want to sell 1,000 shares, we will have a proceed of 1,000 shares times $100 equals $100,000. And out of this $100,000, the broker has a term of 50% margin. And because the dealer has sold the shares on our behalf, when we close the position, we have to pay back the dealer 1,000 shares of that company. So let's say after 1 month, the share price falls to $70 per share. So what happens to our assets and liabilities? When we initially short sold, we received $100,000 in cash. That was our sales proceedings. And we had $50,000 in initial margin. But now that the share price has dropped to $70 a share, if we have to buy back those 1,000 shares, that will cost us $70,000. So on the accounting equation, on the left-hand side for the assets, our total value is the sales proceedings of $100,000 plus $50,000 in margin. And on the right-hand side, our liability is $70,000 with which we have to buy the shares back. And the remaining amount will be our equity. So in this new situation, our equity is going to be whatever amount that balances the equation. So $150,000 minus $70,000 is $80,000. So when we entered the short contract, how much was our margin or equity? It was $50,000. But now, after the share price has dropped to $70,000 or $70 a piece, our equity has risen to $80,000. So our final profit from entering into this short sales position is the new equity minus the old equity, or $80,000 minus $50,000 equals $30,000. And you will notice that this is the same amount by which the share price has fallen. Our position was for $1,000 and the share price has fallen by $30. So our profit from the short sales is the fall in share price times the number of shares that we have taken a short position in. So that covers a brief introduction to short sales. I will see you in the next video. Bye.